Happy Friday out there, Team 42. It's your skipper here, Darius to present our macro minute for Friday, September 20th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro questions are, will the BLJ throw cold water on a year-end rally? Our answers are the BLJ used its forward guidance function to dramatically reduce the risk of further policy normalization over the short to medium term. As such, we do not see the BOJ hiking at its October 31st or December 19th meetings. UAIDA's dovish commentary comes amid hawkish Japanese inflation data for the month of August, an unchanged core CPI forecast around their 2% target, which implies financial stability concerns are currently the dominant driver of the BOJ's reaction function. Much like the Bank of England's dovish response to the UK gilt crisis in the fall of 2022, or the Fed's dovish response to the regional banking crisis in the spring of 2023, or the Fed's recent decision to plunge into a rate-cutting cycle with core PCE tracking 30% higher than their 2% target, we continue to observe evidence of central banks around the world exalting financial stability over price stability. That is a structurally bullish dynamic for risk assets. Transitioning to our 42 macro dashboard here, as always, we'll wrap up with the question from our community. This one's regarding UK long duration bonds and gilts. Says Darius, I love the platform. I've only been here for a few weeks, but so far it's been spot on regarding the signals and timing. So thank you, appreciate that. This person sold their TLT at a perfect time using Dr. Mo, our discretionary risk management overlay, for a nice profit, and also have long duration UK gilts, which they still own in their portfolio, and wonder what our thoughts are, whether the UK long duration gilts will follow TLT and I should sell those, or if they will continue to do well over the near term due to Bank of England also cutting rates similar to the Fed. Keep up the good work and appreciate all that you do for the 42 Macro team and for us retail investors. So thank you again for the kind words to the client there. With respect to, just a little bit of background. So with respect to our views on long duration, we would be underweight long duration here in the context of our sanguine take on the U.S. economy and our expectation that nominal GDP will surprise to the upside over the medium term. And so that's consistent with our views there. We have a similar outlook for the UK economy. So one of the things we do here at 42 Macro is we maintain our grid model, which forecasts growth and inflation on a rolling next 12-month time horizon for all the major economies in the world. And the UK economy has likely to experience accelerating growth and accelerating inflation over the duration of that forecast horizon. And as a function of that, we're probably not going to see the kind of rate cuts that are currently priced into the Bank of England's forward rate curve by British pound money markets. So that's something that investors should be aware of. The UK growth dynamic is currently much less supportive than the U.S. Growth dynamic. So you might see a little bit more rate cuts front loaded by the Bank of England in the coming months. So we wouldn't necessarily be in a rush to sell gilts, but why be long gilts when you can be long UK credit or spread products in the UK market? Because ultimately this is a sanguine backdrop for risk assets. And so from a total return perspective, certainly if you're an institutional investor, obviously this person's not, but if from a total return perspective, you really don't have any business locking in long duration with curves inverted around the world and central banks exalting financial stability over price stability. That's a structurally bullish dynamic for risk assets, so you should be taking more risk in your portfolio. So and there's always an opportunity cost in investing. You can be long something, but if there's a much better way, to express the view in a different product or a different asset market, then you should do that when you have these opportunities in the wind at your back, as we currently do in asset market terms. So investors should be aware of that. That's a more of an institutional bias, but again, if your goal is to maximize upside capture in bull markets and minimize downside capture in bear markets, then you need to know which assets you should be allocating to from an opportunity cost perspective. And certainly we would recommend that investors are in spread products, both in the UK and US fixed income markets here at the current juncture. So we'll wrap it up there. Darius, and by the way, spread products, for those who may not be familiar, spread products are anything that generates a spread over the baseline treasury curve. So and that'd be credit, leverage loans, things like that, mortgage-backed securities, et cetera. So be aware of that. So we'll wrap it up there. Darius Dale presenting our macro minute for Friday, September 20th, 2024. Everyone have a wonderful day. Best of luck out there. We'll catch you back here on Monday. Cheers. Have a great weekend.